Hello everybody, welcome to another video. Today we're going to be talking about, in accounting, we'll be talking about books of prime entry. Now when we talk about prime entry, books of prime entry, this is something which is sort of skimmed over in courses, in tutorials and classes, but we have questions in multiple choice in ACE level, in O level, standard that actually comes on books of prime entry. So you have to know what books of prime entry are if you're giving your O-level exam in accounting or AS level exam in accounting. Okay. Now, when we talk about books of prime entry, these are those books where your transactions are first recorded before they actually are posted to ledger accounts. So they are first recorded in these books and then they're recorded to journal entries and then they posted to ledger accounts. You don't have to worry about what ledger accounts are at this particular time, but we've already gone over journal entries. So you probably want to see our last chapter, which is chapter 2, which actually talks about journal entries. Now, these are basically books of first entry. Anything that happens in your company will actually be recorded in these prime entry books before they record it from anywhere else. Now, apart from cash book, uh, these books do not take into consideration uh, double entry or the double entry that we've or the dual system of accounting that we've discussed in chapter 2. Okay. Now, what are the books of prime entry? We have our books of prime entry as follows. First, we'd have our sales day book where we record our credit sales. Then we have our purchases day book where we record our credit purchases. Then we have our sales return day books where we record our sales returns and purchase returns day book where we return our returns of goods bought on credit. Cash book, all cash transactions and bank transactions are recorded in this book. Petty cash are small cash transactions like stapler or stamps. We'll be coming to that, so don't worry about that, right? And journal, uh, the journal where you have all those things which are recorded, which are not mentioned in the above list. Now, this is the example of a sales day book, right? So anytime a customer buys books, you don't have time to make journal entries. You just record it in your sales day book, and from the sales day book, it's actually forwarded to the into journal entries, right? Because this is exactly where you record it first, and then it's eventually taken into journal entries because transactions are happening so fast in an organization that you don't have time to make journal entries at the snap of a finger, right? So you first record it here, and from here, it's actually taken into journal entries, right? Here's a sales return. If they're uh, returning items, you record it in this sales return day book, and you basically, and then you'll probably take and then it's eventually going to be transferred to journal entries. And obviously, purchase day book. When you make purchases, you're recording it in your purchase day book so that you can actually have records for future use when you want to transfer it to journal entries. Purchase returns, similar, same thing. Now, when you come to the cash book, we record cash book in debit and credit format, right? Because as they're coming in, as cash is coming in and cash is going on, we want to keep a transaction of exactly what's going on so that we can point on or we can zero in on our balance, right? This is a single column cash book. When we talk about double uh, entry cash book, we have discounts, but obviously discounts are not balanced off. Cash is balanced off so that we can zero in on exactly how much cash balance we have at the end of that day or at the end of that month, right? And here is basically an example. Cash balance is this, and bank overdraft is this. Bank overdraft is basically when you are overdrawn, when you don't have when you don't have accounts, when you don't have money in your funds, and you're basically borrowing from the bank, right? So if you look at it, you can go back and forth. So this is your cash, this is your bank credit, this is your cash and bank credit, and this is your third entry, which is your discounts, right? So you can go over the discount, or the first entry. So bank, obviously you're overdrawn, so that's 365. Your cash is on debit, and these are the transactions. Remember, anything that goes out of the cash book is recorded on the credit side, right? So if your cash is decreasing, it's going on the credit side. If your cash is increasing, it's going on the debit side. If your bank is increasing, it's going on the debit side. And if your bank is decreasing, it's going on the credit side, right? So, uh, yeah, this is all for chapter 3.